There is a ton of chatter out there about cash value life insurance, whether it's the Kyle Busch debacle or just people commenting. I see it. Index universal life is way too complicated. No one should ever consider it. And there's so much bad information out there. And these are relatively complex products. And so I totally get it. But my goal in this video today is going to be to make index universal life insurance understandable and digestible in the smallest video we've ever done on this channel.
Hey everybody, quick break from the video. Did you know that we do over 600 IUL and annuity policy reviews every single year? We've built a team, and we do that complimentary, no charge whatsoever. We've built a team ready to do that just for you. The whole purpose of this channel, the whole purpose of our business is to give people options, the right information at the right time so that they can make a good decision with their dollars. And so this is our personal invitation to you to take us up on that. Click the links in the description below, either to book time just to talk with our team or go through the IUL review process, answer a few questions, upload your policy, and we'll take a look and let you know. So that's our invitation. Hope you take us up on it. Now back to the video you're watching.
There's no way I'm actually going to be able to do that, but I'm going to try. We're going to try and make this quick. I'm going to share my screen. We're going to use a life insurance policy doc. We're going to go through it. I'm going to give you the high points. And at the end of this, if you can stick with me through these, 4 to 7 points, you're going to understand index universal life way better than most of the people selling it. For our demonstration today, we're going to be using the Allianz Life Accumulator product. My opinion is right now, and this is the end of the year 2025, this is the best cash accumulation and income vehicle that's out there in the IUL world. So this is the one we're going to be using. We'll refer back to it time and time again. There's just a few things that you need to know about life insurance. Number one, there are fees. So let's start there. We're looking at the charges page on this Allianz policy, and this is going to be for a 45-year-old male putting in a decent amount for every single year, $100,000 a year for 20 years. There are fees in all of these index universal life insurance policies. The charges are heavy while you're funding the policy, and they're larger in the early years versus the late years. So we get out 25 years down the road, your charges are $6,100. You got $6 million of insurance. In the early years, we got $1.5 million of death benefit, and our charges are 19 grand. Okay, so this is an upside down triangle. In most of the vehicles that you're used to, whether it's your 401k, whether it's your 403b, SEP, Simple, TSP, IRA, you invest in mutual funds, you invest in ETFs, all of those vehicles are going to function the opposite way. When you have very little dollars in the vehicle, you pay very little in fees. And as your dollars grow, it's a triangle, right? As your dollars grow, at the bottom, you pay more fees. So if you have a money manager or a mutual fund, and that mutual fund has an 80 basis point expense ratio, if you have $1 in there, your fees are less than if you have $1 million in there, because the fee is based on how much money you have. In life insurance, it's different. Your fee is based on the difference, the gap between your death benefit and your cash value. That's what the fees are based on, the gap between these two numbers. And since you have the least amount of money in the early years, the gap is the widest and your fees are the most. As your dollars grow and the gap closes, 5.2 to 6.1, you pay less in fees. There's also no premium loads when you're actually going out in time and not paying premiums anymore. So yes, there are fees associated with life insurance. The fees are front loaded in the early years. As your cash grows, your fees actually get smaller. As your cash grows, the gap between death benefit and cash narrows. As that gap narrows, your fees get lower. Pretty simple. So if you're paying attention, what does that mean? It means that your fees change from year to year. Yes, they do. They can go up, they can go down, they can stay the same. It's all based on the gap between the death benefit and cash and how old you are. So yes, in an index universal life insurance policy, your fees are going to ebb and flow. They're going to be higher in the early years, then they're going to valley out in your middle years, and then they're going to peak at your late years. That's how it's going to look in just about every single index universal life insurance policy. Number two, you need to understand your investment options inside the policy, your allocation options. What do you actually have access to? So again, we're looking at the Allianz policy. Every single company has a page just like this where they're going to show you the options that you can invest in. But again, The goal of this video is to make it simple. So let me make it simple for you. Every single year, the company, in this case, Allianz, is going to send you an annual statement. In that annual statement, it's going to show you all the options that you can choose from to allocate your dollars towards for the next policy year. And the reason they send you that sheet every single year is because what they need to know is, are they going to pay you the fixed rate of return? Are they going to pay you the fixed rate of return? That's what they need to know. Because in all of these index universal life insurance policies, there is an annually declared fixed rate of return. This is interest rate sensitive. As interest rates go up, your annually declared fixed rate goes up. As interest rates go down, your annually declared fixed rate goes down. It moves with interest rates. Pretty simple. But they need to know, is Dan or John or Mary, are they going to choose the fixed rate of return? And if they are, in this case, they're going to pay you 5.5% for that year. If they're not going to pay you the fixed rate of return, if you're going to say, no, I don't want the fixed rate, I want to invest my money, I want the dollars invested in the S&P, annual point-to-point index. The company says, great. How do they determine what your cap is and what your rates are on this S&P index? Well, it's based on what they're already obligated to pay you, the 5.5% fixed rate of return. So if you have $100,000 in the policy, 5.5% on $100,000 is $5,500. So they're on the hook to pay you $5,500. If you don't want the fixed rate of return, then what they're going to do is they're going to take those $5,500 and they're going to say, all right, well, how much will $5,500 buy us in the form of an S&P annual point-to-point options contract? And it'll buy us a 12.25 cap this year. That's what it'll buy us, a 12.25 cap. Whether you choose the S&P annual point-to-point, whether you choose this S&P futures with no cap, whether you choose this PIMCO account with no cap and a super high participation rate, it doesn't matter. The company spends the exact same amount of dollars on you. It's $5,500. It's the fixed rate. It's what they were going to pay you in the fixed rate. They take that money, instead of paying it to you, they go and they buy an option contract, an option spread. And however that option spread performs, you get all of it. Let me say that again. However that option spread performs, you get all of it. If the company takes your $5,500, your 5.5% fixed rate of return, and you say, I don't want it, I want the S&P, and they go buy you this S&P option that has a 12.25 cap, if the S&P does 40% that year, does the company keep the difference? No, there is no difference. There is no difference because this 5.5% fixed rate of return, in our example, the $5,500, it can't actually buy you an unlimited return in the S&P. They would need way more money to do that. It can only buy you a max upside of 12.25. There is no excess above 12.25. The company doesn't keep what's above 12.25. They don't keep anything. They are passing along to you the fixed rate of return in the form of a riskier with more upside options hedge at your choosing. And they do that every single year. As interest rates go up, the fixed rate goes up. As the fixed rate goes up, they have more money to spend. If you choose a hedge, more than likely the cap goes up. If fixed rates go down, your fixed rate goes down, which means they have less money to spend. If they have less money to spend, they can't buy the same cap on that S&P option. Your cap most likely goes down. And that's how your allocations work every single year from year to year. And you should be doing annual reviews to make sure that you're still in the best position. Number 3, a lot of these companies have bonuses on the products. And the only thing that I want you to know from this video about bonuses is how to evaluate them. So let's pull up the Allianz contract again. Let's take a look at it. They do have bonuses, indexed allocation, bonus options. The only thing I want you to take from this video, because you're going to have to be working with a financial professional to get one of these products, what you need to ask is, are the bonuses guaranteed? Are the bonuses guaranteed? Is the bonus guaranteed? And is it guaranteed to be no cost, or is the cost guaranteed to stay the same? That's all you need to know about bonuses. If you will ask that question, it will provide a whole lot of clarity on how the bonuses work on your particular product that you're considering. Speaking of guarantees, The fourth thing that you need to be looking at are the loan provisions on the policy, especially if you're considering index universal life insurance for cash accumulation and income. How you get that income is of utmost importance. Are you getting it in the form of a loan? Are you getting it in the form of a withdrawal? If it's a loan, is it a variable rate or is it a fixed rate? If it's a fixed rate, does it change how your money is invested, or can you still retain control over how your money is invested? All these are questions that need to be answered by the professional that you've chosen to work with, hopefully someone that you trust. But the main thing that needs to be explored with loan provisions is it a variable or a fixed rate of return? And do you have a real wash loan? Those are the two things you need to know. So we're looking at the Allianz policy. The Allianz policy, they don't call it a participating loan. They call it an indexed loan. Same thing. Companies are going to use different terminology to describe these loans. And they don't call it a wash loan. They call it a fixed loan. But this is their wash loan provision after year 11. What you need to know is it fixed? Is it variable? Is there a real wash loan? In this particular case, as we look at it, we can tell. Rate charged in advance and guaranteed for the life of the policy, 5% annual upfront charge. Okay, that's a fixed rate of return. We know what it's going to be. 5% guaranteed for the life of the policy. Do they change where my money's invested? Your indexed interest credited at the end of the policy year is based on your selected indexed allocation. Perfect. You retain control over how your money is invested if you choose their indexed fixed rate of return, which is 5% in all policy years. If it's a variable rate, it'll say current charge this, maximum charge this. If they dictate where your dollars are invested, there will be some weird verbiage around how the money's actually credited if you choose that rate of return. And you'll notice it when you see it because it won't sound, you'll be like, what's that? They're telling you we choose where your money goes if you choose this loan provision. And then finally, is it a real wash loan? Here's the fixed loan provisions. They're going to charge you, let's just call it 3. They're going to charge you 3 in the first 10 years. They're going to credit you 2 in the first 10 years. Almost every single company has a fixed loan provision like this, where in the first 10 policy years, there's a spread between what you earn and what they charge you. Typically, in year 11 plus, the charge and the credit will equal itself out. Cancel itself out. They're going to charge you 2, they're going to credit you 2. That's a true wash loan provision. There are companies out there that do not have real wash loan provisions. And if you are just choosing apples to apples, you want the company that has a real wash loan provision. Why would you not? If you are considering an index universal life insurance policy for tax-free income in the future, or cash accumulation in a non-market linked variable product, I encourage you to go to our website, leveragedwm.com. You can check the description below. We've got links to where you can book a 30-minute discovery call with us, no obligation. The whole goal is to give you enough information and education for you to be able to make a great decision with your own hard-earned dollars. So go there, leveragedwm.com. You can book a discovery call with us. We'll walk you through all of these different kind of gotcha provisions that it might feel like are in these index universal life insurance policies. The good news is if you have a question, we will have an answer for you. Talk to you soon.